Michael Burry is famous for correctly predicting the greatest economic recession of all time, and for his portrayal by Christian Bale in The Big Short. But Burry has also correctly predicted every last major stock market crash, from the dot-com collapse of the early 2000s to the housing collapse of 2007, and he even kicked off GameStop's meteoric rise when he wrote a letter arguing the company was undervalued. So I think it's fair to call this guy a certified investing genius. But lately, he's been warning of a new economic crisis brewing in the markets, even agreeing with celebrity investor Cathie Wood that we will soon see a global recession.
Every time the yield curve has inverted within 12 months to 18 months, we have been in a recession.
So in this video, I'll explain how inflation hitting new highs, Elon Musk buying Twitter, and Burry starting to agree with his arch nemesis Cathie Wood are all connected. And if Burry's right and we are headed for a worldwide recession, I'll also tell you what you can do now to protect yourself. So welcome to FinTech, hit the like button if you want, and let's just jump into it. So to understand what Burry means when he says he sees shades of the great crash of 1929 in the current market, we need to go back over his history of predicting market crashes. Burry's famous for his bold predictions about the stock market, even going as far as to short the previously unsinkable housing market in 2007, betting it would go down. And when he turned out to be correct, he ended up making his investors 500% returns, and he himself pocketed $100 million when the housing market ultimately collapsed. He later reportedly made a 1,500% return on GameStop during the early days of that stock's rise. And he completely sold out of the market just prior to the most recent correction, potentially saving hundreds of millions of dollars. But in addition to his predictions, he's also recently become known for being very vocal on Twitter, calling out Cathie Wood's ARK Invest fund and Tesla for being overvalued, leading Cathie Wood to say he didn't understand the fundamentals that are creating explosive growth and investment opportunities in the innovation space. And Tesla CEO Elon Musk was even more blunt, calling Burry a broken clock who was always calling for a crash. These high-profile feuds may be why Burry keeps deleting his Twitter, then reopening it for a bit, then deleting it again. But after warning for months that we were in a market bubble, Burry deleted his Twitter just as the market started to drop. Then he reopened it to let people know he was right, but then he deleted Twitter for good. Maybe. But given Burry's previous warnings, why has he recently started buying stocks? And why is he now starting to support Elon Musk, someone he's feuded with in the past? And weirdest of all, Cathie Wood has started to predict a looming global recession. And Michael Burry agrees with her for maybe the first time ever. Oh, and he's still tweeting, I guess. So let's break down all these apparent contradictions, because I think they all ultimately point to the same message. We are headed for a recession. Let's start with answering why Michael Burry is buying stocks with one hand while warning about the market crashing with the other. Well, in his latest 13F filing, which he's required to file publicly to show any recent trades that he's made, we can see exactly what Burry is investing in. And it's a mix of industrials, healthcare, and finance companies for the most part. And while him buying these stocks after previously selling all of his US stocks seems to be bullish on the surface, when we look a little deeper, we can see that all of these companies have very low price to equity ratios, indicating they are being valued very conservatively by the market. Combine this with Burry's still very large cash position, and even without his intermittent Twitter warnings, we could see that he is being extremely conservative with his investments. And this actually ties in with why Michael Burry has recently started voicing support for Tesla and SpaceX CEO Elon Musk, despite their previous disagreements online. Elon Musk is apparently buying Twitter in a deal valuing the company at $44 billion. Musk is going to purchase enough shares in the company to take it completely private, allowing him to more easily make changes to its management and the rules that govern the platform, especially around free speech. And while not everyone is happy with what they see as a change in direction for the company, Michael Burry is not one of them. Michael Burry reportedly applauded Elon Musk's purchase, most likely because Burry himself is a staunch advocate of free speech. But at the same time, Burry also called out Musk in a tweet defending short sellers of Tesla's stock, insinuating that Musk is mad at short sellers because he needs Tesla stock to remain high to fund his purchase of Twitter. After all, Elon Musk is currently the richest man in the world with a net worth of $250 billion, enough to buy Twitter 6 times over. And most of that wealth was created in the last few years with the meteoric rise in Tesla's valuation. But in Burry's eyes, that rise in Tesla's valuation is one of the most obvious signs that the entire market, especially the tech market, is still extremely overvalued. And so this whole acquisition is being funded by essentially funny money from Tesla investors that could disappear overnight in the case of a global meltdown, which Burry seems to think is pretty likely. But then Cathie Wood enters the picture. Now, Cathie Wood doesn't think tech companies are overvalued at all. After all, her fund ARK Invest's largest holding is over $1 billion in Tesla stock. But she does think we are headed for a recession, and Michael Burry couldn't agree more.
The yield curve has inverted. Every time the yield curve has inverted within 12 months to 18 months, we have been in a recession.
So we know Burry is buying stocks conservatively. We know he thinks Tesla and tech in general is overvalued, and we also know that he agrees with one of the most prominent technology investors in that a recession is coming. But why does Michael Burry think that a recession is inevitable, and what does it mean for our portfolios? So there are several signals both Burry and Wood can point to that indicate we may be headed for a recession. The first we've already heard, which is that every time in history the yield curve has inverted, we've seen a recession in 12 to 18 months, and the yield curve inverted this year. This means that the bond market would rather pay more interest on a 2-year bond than a 10-year bond, indicating a belief that the short term is so much higher risk than the long term that you would have to pay me extra to give me my money back sooner. Another indicator which Burry is even more focused on are the valuations of stocks in the market. Now, Burry has called for stock market crashes in the past that have never ended up happening, or if they have, sometimes it takes a while. In 2019, for example, he thought ETFs were in a bubble, and the S&P 500 is still nearly 60% higher now than it was then. He also warned in 2021 that we were headed for the mother of all crashes, and called out everything from Bitcoin to Robinhood to software as a service stocks as being overvalued. And he even went so far as to say this: "People always ask me what is going on in the markets. It's simple. Greatest speculative bubble of all time in all things by 2 orders of magnitude." And if we look at the average price to equity ratio in the S&P 500, we do see a brief spike in 2020 before values fell back down closer to baseline in early 2022. But that recent dip certainly wasn't an order of magnitude drop. Though to be fair, the S&P 500 is currently sitting at an average PE ratio of nearly 22, which is still well above the mean for the entire history of the stock market, which normally sits around 30% below today's valuations. But outside of those charts, there's also a causal argument we can make for why we are headed for a recession. First, just look at inflation. According to the CPI, or Consumer Price Index, we've seen prices rise 6.5% over the past year on average, with certain areas like energy increasing much more dramatically than that. And while some of that may be due to temporary supply chain issues causing increased transportation costs, that's still a lot of sustained price increases for the market to bear for such a long time. Now, normally the Federal Reserve is in charge of keeping inflation in check, and they seek to keep the inflation rate around 2% per year. That's the sweet spot for keeping it stable while protecting jobs. And that's exactly what Fed Chairman Jerome Powell has been trying to do. He's actively trying to drive down inflation. So okay, but what does that have to do with a recession? Well, the definition of a recession is defined as a period where economic activity is reduced, usually with GDP dropping and unemployment rising. And usually inflation happens in the opposite of a recession, since high inflation generally means high economic output. In fact, the Fed's best lever for lowering inflation is to intentionally try to slow down the economy by raising interest rates. So it's a trade-off. We get less economic output, but at least inflation slows down. At least that's how it's supposed to work. According to the University of Michigan, consumer sentiment about the economy is the lowest it's been since the 2008-09 crisis, which doesn't really sound like a white-hot economy that needs cooling off. This has led some investors to worry that we could fall into what's known as stagflation, where wages stagnate while people's earning power is slowly whittled away by rising prices. This is exactly what happened to the US economy in the 1970s. That would be absolutely devastating for the average consumer today, where over 60% of people already live paycheck to paycheck. So between an inverted yield curve, high valuations in the market, uncertainty around the Fed, and even the possibility of stagflation lingering overhead, it would make sense to feel a little nervous about what the future holds, especially with Burry consistently reminding us that we could always have another Great Depression. So what should we be doing in response to Cathie Wood and Michael Burry's predictions? Well, let's first talk about Burry saying that the market is overvalued. Now yes, the S&P 500's PE ratio is higher than its average over the past past 100 plus years, and that metric alone might lead you to think the market is overvalued. But high values today don't necessarily mean we will revert back to the mean. While companies might be valued more highly than in the past, it's also possible that the companies are simply worth more now because they're growing faster. If one company is growing at 50% per year while another is growing at 5%, even if they make the same amount of money, the former is obviously way more valuable. Google, for example, grew their revenue 41% last year. So if they could maintain that for a few years without the stock price changing, their PE ratio will naturally drop every subsequent year as they make more and more money. But okay, maybe Burry is right and the market is going to crash. Does that mean that we should sell? Well, if we sell out, there are only two options. One, we sell and successfully avoid a crash, or two, we sell and miss a run up in the market while we're on the sidelines holding cash. Kind of like what happened to investors who sold when the market briefly dipped in 2020. Well, when we look at the data, it pretty clearly shows that selling out of the market is the worst decision you could make. A Bank of America study compared the hypothetical returns of investing $1,000 into the S&P 500 from 2010 until 2020, and either doing it for the entire decade or missing the 10 best days in the market. Now, if you'd invested during that time, your $1,000 would now be worth $2,900. But if you missed just the 10 best days, you would only have $1,900 at the end. And if we extend that to look all the way back until 1930, if you had invested that entire time, your $1,000 would now be worth $150,000. And if you had missed just the 10 best days each decade during that time, you would only have $1,900 today. And even if you had invested all your money in 2007, right before the stock market crashed, literally the worst timing anyone could possibly have, as long as you held through the crash and the subsequent recovery, you would have made all of your money back by 2012, and you would have tripled your money between then and now. So most of the time, you will lose money by trying to time the market and pulling your investments out. And while yes, someone like Michael Burry might say the market will crash, and he has been right in the past, he's also predicted many crashes that never actually came about. Tesla is now the most valuable car company in the world, worth nearly $1 trillion. Technology companies, which have been hit hard in 2022, are still 60% higher than they were at the start of 2020. This article shows this guy who correctly predicted the 2020 crash, which he'd been calling for since 2017. And while this guy isn't Michael Burry, I think this still illustrates an important point. If you sold out in 2017 when he said to and skipped all the rise in the market we've seen since then, you would have missed out on a 60% rise in the Dow, a 75% rise in the S&P 500, and a 130% rise in the NASDAQ, even accounting for the dips in 2020 and at the start of 2022. So my strategy is staying the same. I'm staying invested in the market. If my stocks rise, I'll make some money, and if they drop, I'll just buy in at a cheaper price, because I know that on average, I will make more money staying invested. And while I respect Michael Burry predicting the Great Recession, we need to remember that there are people who sold out of the stock market in 2008 and never bought back in. And unless they were already rich, they're going to have a very hard time ever building wealth or even retiring. Don't forget to like and subscribe, and I'll see you next time.